Hey everyone, welcome back to Commerce Made Easy by Aiswarya. If you have been following along with our series, give yourself a quick pat on the back because you have officially made it to part 3 of our complete cash flow statement breakdown. In our first 2 videos, we nailed down the theories, the legal rules under AS3, and exactly what counts as cash and cash equivalents. If you missed those parts, don't worry. The links are right down in the comment box below. Go check them out first. Because today, we are finally moving past the definitions and getting into the real action. We are going to see how cash actually moves through a business. But before I pull out the digital whiteboard, let's do a quick check. If you haven't already, take 2 seconds right now to hit that subscribe button and turn on the notification bell. Give this video a big like to help other commerce students find it, and share it right now in your school WhatsApp groups or with your study buddies. Your support means the world to me. And it's what keeps this channel running for you guys. All done? Awesome. Grab your pens, open your notebooks, and let's make commerce easy. Alright, now that we have our main character, cash, completely figured out, let's look at the second word in the chapter title, flow. When we say cash flow, what do we actually mean? In the simplest human language possible, cash flow just means the movement of cash in and out of the business. Think of your business like a local swimming pool. When water comes through the pipes into the pool, the water level goes up. In business, when cash comes into your enterprise, we call it a cash inflow. For example, when a customer walks into your shop, buys a smartphone, and hands you cash, that's cash flowing in. On the other hand, when you open the drain and water leaves the pool, the level goes down. In business, when cash goes out of your enterprise, we call it a cash outflow. For instance, when you pay your monthly rent, pay salaries to your staff, or buy inventory, cash is flowing out. So, a cash flow statement is literally just a diary tracking the incoming and outgoing tide of your money. Now, here is a line from your textbook that confuses almost every single student. The textbook says, cash flow arises due to transactions between cash items and non-cash items. You might look at that and think, wait, ma'am, if it's a cash flow statement, why on earth are we talking about non-cash items? That makes zero sense. Let's break this down with a super easy example because once you get this, you will never make a mistake in your practical problems. For a cash flow to actually happen, a transaction must have 1 foot in the cash world and 1 foot in the non-cash world. If a transaction happens purely inside the cash world or purely inside the non-cash world, the net cash balance of the company doesn't change at all. Let's look at 3 quick scenarios to see what I mean. Scenario A. Cash versus non-cash, real cash flow, white heavy checkmark. Imagine you go to a wholesaler and buy a massive delivery truck for your business. You pay them 10 lakhs rupees in cash. The truck is a fixed asset, a non-cash item. The money you paid is cash, a cash item. Because a non-cash item switched places with a cash item, your cash balance dropped by 10 lakhs rupees. Boom! A cash outflow has taken place. Scenario B. Cash versus cash, no cash flow, crossmark. What if you take 50,000 rupee physical cash from your office drawer and walk over to the bank to deposit it into your company's current account? Office cash is a cash item. Bank balance is also a cash item. Did the total money owned by the company change? No. It just moved from your left pocket to your right pocket. Because it's just cash moving into cash, there is zero net cash flow. What if you buy a piece of machinery worth 5 lakhs rupees, but instead of paying cash, you give the seller shares of your company? Machinery is a non-cash item. Shares are also a non-cash item. Since no real money ever changed hands, there is absolutely no cash flow here either. So, write this down in your notebook notes. For a cash flow to exist, cash must interact with a non-cash item. Alright, now that we know how cash flows, by interacting with non-cash items, let's look at the 2 directions this money can move. This is incredibly straightforward, but it's the absolute foundation for every single ledger and statement you'll build later. There are only 2 types of cash flows you need to care about: cash inflows and cash outflows. Let's break them down with the exact examples the CBSE board loves to throw at you. First one is cash inflow, that is, receipt of cash. Simply put, this is when money is entering your business's bank account or cash box. the cash balance goes up. Let's take the textbook example, sale of machinery for cash. Imagine your company has an old delivery truck or a printing machine sitting in the warehouse that you don't use anymore. You find a buyer, sell it to them, and they hand you 2 lakhs rupees in cash. The machinery leaves your business, that's the non-cash item going out. The cold, hard cash enters your business, that's the cash item coming in. Because your bank balance just increased by 2 lakhs rupees, this is a clear-cut case of a cash inflow. Anytime you receive a check, a UPI payment, or physical cash from selling anything, it's an inflow. Second one is cash outflow, means the payment of cash. This is the exact opposite. This is when money is leaving your business to go somewhere else. Your cash balance goes down. Our textbook example here is purchase of machinery for cash. Flip the script. Imagine your business is growing and you need to buy a brand new, high-speed packaging machine. You go to a supplier, buy the machine, and write them a check for 5 lakhs rupees. The new machine arrives at your factory, non-cash item coming in. The 5 lakhs rupees leaves your bank account, cash item going out. Because your available cash dropped by 5 lakhs rupees to pay for that asset, this is a cash outflow. Anytime you are signing a check, paying bills, or handing over cash, the money is flowing out. Awesome! Now that we have the definitions of inflows and outflows down, let's look at 5 classic, real-world examples that you will see in almost every single exam problem. Let's figure out together whether they are inflows or outflows and exactly why. Example 1. Cash collected from debtors. First up, let's say a customer named Sonu bought some goods from your shop on credit last month. He didn't pay you then, so he became your debtor, a non-cash asset. Today, Sonu walks into your shop, smiles, and hands you 20,000 rupees in cash to clear his bill. Your debtor balance goes down, non-cash item changes. Your actual cash balance goes up. Since money is entering your business, cash collected from debtors is always a cash inflow. Example 2. Payment to creditors. Now let's flip it. Imagine you bought raw materials on credit from a supplier last month, making them your creditor, a non-cash liability. Today is the due date, so you log into your business banking app and transfer 50,000 rupee to their account. The creditor balance goes down. But your bank balance also drops by 50,000 rupees because you paid them. Since money is exiting your system, payment to creditors is a classic cash outflow. Example 3. Payment of wages and salaries. Think about the end of the month. Your hard-working employees have done their jobs, and it's time to pay them. You write checks or do direct bank transfers for their salaries. You are getting their valuable labor and services, non-cash. You are giving up real money from your bank account. Because that money is leaving your business pocket to go into your employees' pockets, this is a cash outflow. Example 4. Receipt of dividend. This one sounds a little fancy, but it's a beautiful thing. Imagine your company had some extra cash lying around last year, so you invested it by buying shares in a massive company like Reliance or Apple. Today, that company does really well and decides to share its profits with you by depositing a dividend check directly into your bank account. Your investment, non-cash, earned you a direct reward. New money just landed in your bank account. Because cash is streaming into your business from an outside investment, receiving a dividend is a fantastic cash inflow. Example 5. Payment of interest. Finally, let's say your business took a big loan from a bank to expand your factory. Every single month, the bank doesn't just want their loan money back, they demand their interest payment. When you pay that monthly interest charge, the bank balance goes down. Cash is leaving the company to satisfy the bank. So, just like paying salaries or rent, paying interest on a loan is a definite cash outflow. Okay, my brilliant commerce stars, lean in close for this one. We have reached the absolute most important point of this entire chapter. If you are sitting down, make sure you're paying 100% attention right now, because this is the exact spot where thousands of class 12 students lose easy marks in their board exams. Write this down in your notebooks with a giant red star next to it. The purchase or sale of cash equivalents is strictly not shown in the cash flow statement. Now you might be thinking, wait, Aiswarya ma'am, if I buy short-term investment or a treasury bill, I'm using money to buy it, right? So shouldn't that be a cash outflow? It sounds like it should be, But let's break it down using a very simple human example. Imagine you are going on a vacation to Dubai. You have 50,000 rupee cash in your wallet, but you don't want to carry all those physical paper notes around. So, you walk up to a bank counter and buy a prepaid international travel card worth 50,000 rupees. Let's look at your net wealth at that exact second. Before walking into the bank, you had 50,000 rupees in paper notes. After walking out of the bank, you have 0 rupees in paper notes, but you have 50,000 rupees sitting safely on a plastic card. Did you suddenly become richer? No. Did you suddenly lose money or spend it? No. You didn't buy a dress, you didn't buy food. You just shifted your money from one pocket to another. You simply changed the form of your cash from paper money to a digital card. Your total cash balance remained exactly the same. This is exactly what happens in a company. Remember our golden definition from part 2? Under as 3, the term cash actually means cash plus bank balance plus cash equivalents like marketable securities and treasury bills. They are all members of the exact same family. So, if a company takes 1 lakh rupees from its bank account and buys a 3-month treasury bill, your bank balance goes down by 1 lakh rupees. Your treasury bill balance goes up by 1 lakh rupees. Since both items live inside the exact same cash and cash equivalents bucket, the total net balance of the bucket hasn't changed at all. It is just a change in the form of your cash. No money actually entered the company from the outside world, and no money actually left the company to pay an expense. Because a cash flow statement only tracks money crossing the border in or out of that bucket, moving money inside the bucket is completely ignored. It's like moving a 10 rupee coin from your left pocket to your right pocket. Your pants still hold the exact same 10 rupees. So, if an exam question says, company purchased marketable securities worth 20,000 rupees, what will you do? You will completely ignore it in your cash flow statement. Don't write it under operating, investing, or financing. Just leave it alone. Now, let's see if you can crack this related twist question. If a company sells a treasury bill for cash, does that count as a cash inflow, a cash outflow, or no cash flow at all? Think about the bucket rule we just talked about, scroll down, and drop your answer in the comments right now. Let's see who gets a perfect score on today's concept. If this explanation finally made this tricky point clear for you, please show some love. Hit that subscribe button, give this video a big like, and share it with your friends who are stressing over accounts. Thank you so much for studying with me today on Commerce Made Easy by Aiswarya. You are doing absolutely amazing. Keep your concepts crystal clear, and I will see you in part 4 where we finally start sorting real transactions into our big activity buckets. Goodbye. See you in the next class.